Hi everyone, we are now going to take a look at Chapter 11. So in Chapter 11, we're totally switching gears and talking about a different type of accounting, one you haven't seen before, and it's accounting for state and local governments. So this chapter is the first of two chapters actually on how state and local governments report information. And we have various objectives. Now, our first objective is explaining the history of and the reasons for this unique characteristics of the financial statements produced by state and local governments. So why is it different than what we're used to, what we've learned so far in accounting, in our financial accounting? Well, oops, let me go back. We don't just merely match expenses with earned revenues because we're not earning revenues in a state and local government so that net income can be determined. Remember, tax rates and allocation of limited financial resources among things such as education, police protection, welfare, and the environment create debates throughout the nation. So without a profit motive, what should be reported by a government and who are the potential users of that financial information? The primary purpose is to provide services. So it's right in your book. The primary purpose of government is to enhance or maintain the well-being of citizens, not to make a profit, by providing services in accordance with public policy goals. In contrast, business enterprises focus primarily on wealth, interacting principally with those segments of society that fulfill their mission of generating a financial return for their shareholders. So, there are crucial differences that generate user demand for unique information. The primary purpose is to provide services in accordance with public policy goals. Governments serve a much broader group of stakeholders than just the owners, the taxpayers, the citizens of the local and state government. Bondholders who own bonds of the company, oversight groups, elected officials. Monitoring actual compliance with budgeted public policy priorities is central to government public accountability reporting. And you're going to see in governmental accounting, we record our budget within our accounting system and we compare it to actual because you are held accountable as a person, a representative on the government to be in line with what you told the public your budget would be, what it actually is coming out to be, and why there's a difference. And governments exist longer than for-profit businesses and are not typically subject to bankruptcy and dissolution like a regular company would be. So that's just some of the reasons we have this different type of accounting for these state and local, for governmental entities. So the GASB was formed, the Governmental Accounting Standards Board, in 1984, and it's the FASB, but for government. So they have concept statements, and their first one identified three basic groups of users of governmental accounting information. Your first one being citizenry. Now, the citizens want to evaluate the likelihood of tax or service fee increases. They want to determine the sources and uses of resources and forecast revenues in order to influence spending decisions. Who else needs the information? Legislative and oversight bodies. They want to assess the overall financial condition when developing budgets and program recommendations to monitor operating results to assure compliance with mandates, what's in the law, what they have to do, and make sure it's getting done, to determine the reasonableness of fees and the need for tax changes if necessary, and to ascertain the ability to finance new programs and capital needs that they want. Remember, they're the ones calling the shots. And then there are investors and creditors of the government, and they want to know the amount of available and likely future resources. They want to see debt position of the government and the ability to service that debt. So because we have these three different groups of governmental who want to see governmental accounting information, we're actually required to create two sets of financial statements. Let's take a look at them. Sorry. Ooh, wrong tube. So we have to differentiate. That's our next objective. Excuse me, one second. Sorry about that. Okay. Differentiate between the two different sets of financial statements. And we're going to take a good look at them this chapter. So the GASB requires these two sets of financial statements by state and local governments, and they each have their own unique principles and objectives. The first one are what we call fund financial statements. And you're going to see accounting for governments is done by funds. We're going to define those. So because we do the accounting that way normally, we have always done fund financial statements. These show restrictions on the use of resources and report only current revenues and current expenditures from certain activities. Government-wide financial statements report all revenues and costs with a long-term focus to provide information to creditors so that they could assess the likelihood of being repaid. So those are the two sets. Okay. Now, what do fund financial statements do? Exactly what you see there. These statements present individual government activities and the amount of financial resources allocated to them, as well as the use of those resources. So citizens can assess the government's fiscal accountability in raising and utilizing money from these statements. Here's an example. Fund financial statements report the amount spent in the current year on services like public safety, education, health, sanitation, maybe even the construction of new roads. The primary measurement focus for public services activities is not if they made a profit, but is the amount and the changes in current resources, such as cash and receivables. Those are the only assets the government has to spend. So when it comes to fund financial statements, the accounting is a little different. We use modified accrual accounting to create those financial statements. What does this mean? We record revenues when resulting current financial resources are measurable and available to be used, and expenditures when they reduce current financial resources. So let's take a quick look at an example of that on page 520 of your book. And let me find it there. So this is the first type of financial statements. I'm almost there. So if you look under fund financial statements, the third paragraph, for example, the city of Norfolk, Virginia discovered that the city generally considers revenues, except for grant revenues, to be available if they are collected within 45 days of the end of the fiscal year. Therefore, using modified accrual accounting, 2015 revenue collected by the city within the first 45 days in 2016 is recognized in 2015 because that money will be available to pay those 2015 expenditures. However, in Virginia, their policy differs. So you're going to see that they differ, but that's what they're talking about here when it comes to modified accrual accounting. And we're going to look at it some more. Just introducing you. So that's one set of financial statements, and we'll see them later. The other set of financial statements is pretty much like what we're used to doing, government-wide. So it's just not looking at a particular activity, a fund for a particular activity. This reports on all the financial affairs of the government as a whole. This became a requirement about 15 years ago, so only around 2004, 2005. So these weren't around when I went to college. The fund financial statements were. They were created, though, to report a government's financial affairs as a whole. We didn't have that ability. We went by funds. So they're providing information for decision makers to evaluate the government as a whole for their financial position. Has it improved or deteriorated? To understand how the cost of providing services to the citizens, see how the government finances its programs, and the extent to which government has invested in capital assets. Things as roads, bridges, and other infrastructure. Fund financial statements don't do that, and you'll see that. So they focus on all economic resources, not just cash and accounts receivable. And further, these financial statements utilize accrual accounting. So maybe you use modified accrual accounting for your everyday recording of information for the government entity you're at. You'll make your fund financial statements, but then you have to convert that modified accrual accounting to accrual accounting. So this is pretty much like the company financial statements we do. We make sure we account for the information the same way. We'll have depreciation, we'll have accruals of stuff, expenses and revenues. Okay, that's not, fund financial statements do not do that. So that's why we have these two sets. So this is a great little table showing us the difference. When it comes to fund financial statements, you'll see there it says individual activities are focused on for fund financial statements, government as a whole, for government-wide. When it comes to fund financial statements, the measurement focuses on cash and investments and receivables and claims to those assets, so only current financial resources. Where government-wide, it's all economic resources, all the assets, all the liabilities. When it comes to fund financial statements, the information is telling us the inflows and outflows for this year, for a particular activity. Government-wide, it's looking at the overall financial health of the company. And then the timing and recognition of transactions, modified accrual accounting for fund financial statements, accrual accounting for government-wide. I just want to see if there's anything else I want to add to that. Okay, I think that's what we wanted to talk about there. Okay, so you know, the little asterisk right here, right in there, see fund financial statements. The information provided here for fund financial statement only apply to public service activities. So these are activities that the service is being provided to the public at large, like public safety, the police, the fire, education. They'll each be an activity. As will be discussed shortly, other activities in fund financial statements are reported more in keeping with government-wide financial statements. So not everything a government does is included in fund financial statements, but it is included in government-wide financial statements. Okay. Now, our third objective is understanding the reason that fund accounting has traditionally been a prominent factor in our everyday recording of transactions in the government entity. And it's really because governmental units report a diverse array of activities financed from numerous sources. So you have to remember, in a business, they're, selling food. They are providing accounting services. They are, they're usually doing one major type of activity, where government, they're doing lots of different things. Like we said, they have the fire department going, the police, they have tax collection happening. And that's just to name a few. So governments operate through many relatively independent departments and functions. So it makes more sense to collect their information by activity. So a fund would be an activity, and then it would have its own bookkeeping system within that activity. So each activity will have their own revenue and expense categories of accounts. So separate information is accumulated for every activity. The school system will have their own fund. The debt payment, how we pay back maybe bonds that the government issues. The road construction activity will have its own, etc. So if you take a look on page 523, great list of items: public safety, highway maintenance, the sanitation, health, welfare, culture and recreation, education, parks. That's just those. And you can see the list on the other side. These are all the different kinds of activities that may be occurring, and that's not exclusive, within a government. So that's why these separate funds are so necessary and popular. Okay, so we're going to identify 3 fund types and then individual fund categories within each. So let's take a look. All funds in a government, so all activities fall into one of 3 categories. You're going to have governmental funds. So this includes all funds that account for activities a government carries out for its citizens, with services that are financed primarily through taxes and other general revenue sources. Okay, things such as the fire department, the school systems. These are considered governmental activity/funds. Another type of fund, proprietary funds. Now, these account for the government's ongoing activities that are similar to those conducted by a for-profit entity. So this fund type encompasses operations that assess a user charge, so that determining profitability or cost recovery is important, like a business. For example, if the local government has a municipal golf course, that is a government-run golf course. Or if there's a toll road running through. So they're collecting funds for that activity. So we want to see, are we covering our costs from the funds we're collecting specifically for that activity? Fiduciary funds. These account for monies held by the government in a trustee or agency capacity. So they're just holding on to the money. Such assets must be maintained for others and cannot be used by the officials for government programs. A common example, the monitoring of assets held in a pension plan for government employees such as teachers or sanitation workers. So any kind of funds in this capacity, the government has in this capacity, it's not their money to use. It's money they're collecting for someone else or holding on to for someone else. Is considered fiduciary category. So most of our activities are going to fall in the governmental funds category, but we want to make sure you understand there are 2 other types. So we're going to go through the various types or even more, the various funds within each type. First, Our first classification, governmental funds. Again, we define what's primarily a government fund. This is your most dominant fund because it's because of its service orientation. Governmental funds usually are the most predominant in many states and municipal accounting systems. The internal accounting system maintains individual funds for every distinct service function: public safety, libraries, construction of a town hall, so on. Each governmental fund accumulates and expends current financial resources to achieve one or more public goals, not to make a profit, to reach a public goal. To provide better reported information and control, governmental funds are further subdivided into one of 5 categories. So we're going to talk about each one. General fund, special revenue fund, capital projects fund, debt service fund, and permanent funds. So this classification system forms an overall structure for financial reporting purposes. So let's talk about the general fund. Let's get acquainted with each one of these. The GASB's definition of a general fund is to account for and report all financial resources not accounted for and reported in another fund. So it's very general. It implies that it records only miscellaneous revenues and expenditures, but it accounts for many of a government's most important ongoing functions. For example, there's 2013's fund financial statements for the city of Baltimore disclose 11 major areas of current expenditures within its general fund. So, let's see, I have a little note here. Let me go to page 524. Oh, I like this one. It's under governmental, oh, that's a special revenues fund, I'm sorry. The city of Baltimore, Maryland, there it is. And here are their 11 major funds for the city of Baltimore. General government, public safety and regulation, conservation of health, social services, education, public library. So these are all the types of expenditures. So they're from different activities. They come out of their general fund, and that's where they do the accounting for them. Oops. Okay, the next one. The next one is a special revenue fund. Now, the special revenue fund accounts for resources that are restricted or committed for a specific purpose other than paying off loans or bonds, debt payments, or capital projects, building stuff, buying long-term assets, or building infrastructure. Because of donor stipulations or legislative mandates of the law, these financial resources must be spent in a designated fashion. So they tell us about St. Paul here. They report 16 individual special revenue funds. City sales tax. Okay. Administration fees for charitable gambling. That's another special revenue. So it has to be used for something. Money received from solid waste and recycling programs. So if you're sending in as a citizen, sending money in, that's a special revenue fund to cover those kind of programs. And I'm taking you back to page 524. Right above it says capital projects. I like this one. In the same manner, the city of Charlotte, North Carolina uses a special revenue fund to account for money from a room occupancy tax. Okay, so the mandate is there's a room occupancy tax, and it says that money that's collected must go to support the NASCAR Hall of Fame. So you can see what we're talking about here. It's account for resources restricted or committed for a specific purpose. The next type of fund is a capital projects fund. Now, capital projects, as the title implies, is a fund for financial resources restricted, committed, or assigned for capital outlays, such as acquiring or constructing bridges, high schools, roads, municipal office complexes. So capital projects fund. So this is where we're putting money to purchase the assets or sell bonds or transfer, the funding for these projects normally comes from a number of sources, maybe grants from another government, sale of bonds, governments sell bonds as well, or money from the general fund, general revenue. The actual capital asset, this is interesting because this is not how it is in our financial world. Being purchased or constructed is not reported here. We only put the money to finance the acquisition in a capital projects fund. Here's an example. Lexington Fayette Urban County Government in Kentucky reported as of June 30th, 2014 that it held a total of more than 20.1 million of current financial resources in 11 different capital project funds to be used in a variety of projects, such as the acquisition or construction of a cultural center. So that's money set aside for these projects, road projects, building a public library, computer equipment. Okay, so it's not the asset that's being bought, it's where the money goes to fund the asset purchase. The final, I think that's our final, yes, the debt service fund. These record financial resources accumulated to pay long-term liabilities and interest as they come due. However, this fund does not monitor a government's long-term debt. So there's no long-term notes payable in this fund. This is only where the money is being put aside to pay off long-term debts. So debt service funds are created to account for monetary balances that are restricted, committed, or assigned for the eventual payment needed to satisfy long-term liabilities. So we don't leave the money in the general fund or in any fund that could be used, because this money is being set aside to pay off long-term debt. For example, June 30th, 2014, the city of Birmingham, Alabama, reported holding approximately 1.6 million of cash and investments in its debt service fund to pay long-term debt and interest. For the year then ended, more than 20.2 million in principal payments were made from the fund, with a 10.7 million in interest payments. So very different than what we're used to. Sorry, the final one, permanent funds. Account for financial resources restricted by external donors, contract, or legislation. So this could be part of the law, with the stipulation that the principal can never be spent, but any income can be used by the government, often for specified public programs. For instance, City of Dallas, Texas reported holding 9.7 million as of September 30th from private donations whose income was designated to maintain 4 different local parks. So private donations came in. This money was put into an investment of some sort. The principal that was given can never be spent, but the income from it is to be used to maintain local parks and help finance other municipal projects. We usually refer to these kind of gifts from private donations as endowments. And that's when they give money, restrict what they gave, but allow for any income made off of that investment or endowment to be used for a specific purpose. So those are our general or our governmental funds. Again, go back, we have a few of them, right? The general fund, special revenue fund. Remember, that's where account for resources that are restricted or committed for a specific purpose. So revenue goes in there for a specific purpose. We have the capital projects fund, the debt service fund, and the permanent funds. Now, the next kind of classification are proprietary funds. Remember, these are a category of accounts for government activities that assess a user fee. And these really are like a business. So some examples could be the government bus system like Luzerne County Transportation Authority, or toll road, or their subway lines run by the government. The big thing here is that they assess the user of these services a fee. So the user charges help recover part of the cost. So we're looking to see, does the user charge help the government make a profit, or at least cover the costs of that activity? So in that sense, it's a lot like a for-profit activity. Accrual accounting is used to recognize assets and liabilities in these types of funds. Proprietary funds are also broken into two divisions, and internal service funds. Enterprise funds. Any government operation that is open to the public and financed at least in part by user charges is likely to be classified as an enterprise fund. Here's some examples. A municipality, for example, might generate revenues from the use of a swimming pool, a public swimming pool, a golf course, an airport, water and sewer service, and the like. So the user is being charged for that item. An activity must be accounted for here. However, if any of these conditions below are met, revenues generated by the activity provide the sole security for the activity's debts. Laws or regs require recovering the activity's costs through fees and charges. Fees are set at prices intended to recover costs. Okay, so any activity that charges the public a user fee may be classified as an enterprise fund. The designation is required if you meet one of those three criteria. Here's an example. City of Houston generated $1.4 billion in revenue during the year from 3 enterprise funds: the aviation system, the utility system, and their convention and entertainment facilities. So these were all government activities. They charge users, and these types of activities fall under the enterprise fund because of the type of activity it is. Internal service funds, also proprietary fund. This is where we account for any operation that provides services to another governmental department for a fee. The services are provided for the primary benefit of the parties within the government. So as you can see, probably most of our proprietary funds will be in our enterprise area. It's accounted for similar to a for-profit operation in the private sector. So some examples. The city of Lincoln, Nebraska reported 8 operations that were accounted for as separate internal service funds that provide a variety of services such as engineering, revolving fund, and copy service funds. Information Systems Fund is another, to account for the cost of operating a central data processing facility. Engineering Revolving Fund, to account for the cost of operating a central engineering pool. Now, what this is a lot like is corporations do this. Instead of having each location have their own accounts payable area and everybody has their own checkbook in all the different divisions in a corporation, the corporation will centralize certain functions like accounts receivable or accounts payable, and have a service center provide those activities and then charge the cost of those activities to the different divisions. That's the same kind of thing here. So they're providing a service. This is where we do the accounting, where one part of the one activity is providing services to the other governmental department for a fee. So that everybody isn't doing their own, everybody has an information service area. No, we just need one, and then we'll charge each area for how much it costs to provide that service to them. Keep track of that in the proprietary funds. The final category of funds in a state and local government are fiduciary funds. So these account for assets held in a trustee or agency capacity. So they're not the government's money. They're holding them for external parties so that the money cannot be used to support the reporting government's programs. So they can't use it. Like proprietary funds, fiduciary funds use the economic resources management focus and accrual accounting for the timing of revenues and expenses. Because these assets are not available for the benefit of the reporting government, fiduciary funds are omitted entirely from government-wide financial statements, and they make their own separate financial statements. So remember, we have fund financial statements, and then we have government-wide. Government-wide says, look at all the assets and liabilities as the government as a whole. Nope, don't include fiduciary funds. They're not ours anyway. There are usually 4 different fund types. Let's take a look. The first being investments. This is usually a fund where we account for the outside portion of investment pools when the reporting government has accumulated financial resources from other governments. Okay, so let's say we want to invest our money in this mutual fund, and we're going to be assessed a 5% service charge if we invest our money. And we know the town over, the city down a couple miles away, and another city, they also want to invest in this mutual fund. And if they each individually invest, they're going to have a 5% fee. But if we pull all of our money together and invest as one, we'll have a 1% fee. That's what we're talking about here. So if they ask us, well, we're going to send you our money and you guys invest it with yours, now we have an investment trust. A private purpose trust fund. The second fiduciary fund type accounts for monies held in a trustee capacity for the benefit of specifically designated external parties, such as individuals, private organizations, or other governments. Again, some unclaimed property is usually recorded here. So sometimes people never claim something they own, and the state gains receipt of it. It's usually money. They never claimed their tax refund. They never claimed something that the government owned them. Well, the government doesn't sit there and go, well, we're going to leave this in accounts receivable or accounts payable. No, they put it in as private purpose trust and let it earn money. And when somebody comes and claims it, they'll get their money. A pension trust. This is where we account for the assets held to pay employee retirement benefits. Because of the need to provide adequate money for retired government workers for a period of time that might last for years, this fund type can become quite large. And it's probably one of the most expensive things to state and local governments, is funding this type of trust. And then we have the agency funds. This fund records any resources a government holds as an asset for individuals, private organizations, or other governmental units. For example, one government could collect taxes and tolls on behalf of another. Okay? For instance, when I do a tax return, sometimes I have a client who works in New Jersey but lives in Pennsylvania. Okay. Well, Pennsylvania and New Jersey have an agreement that basically says if you paid taxes in New Jersey, it's like you paid them to Pennsylvania. But really, Pennsylvania should be collecting those taxes. New Jersey has them. So when Pennsylvania and New Jersey receive those tax returns, they know a part of that money must be paid over. New Jersey knows a part of that money must be paid to Pennsylvania because that person really should have paid those taxes to Pennsylvania. That's what we're talking about here. Sometimes tolls. Maybe the one state is collecting tolls on behalf of another. Well, that isn't the state collecting its money. They're just holding on to that as an agent for the other state, and then they will transfer it where it needs to be. Okay, so those are our 4 types of fiduciary funds. We have governmental funds, 5 different types. Remember, general, special revenue, capital projects, debt service permanent. Then we have our proprietary with our enterprise and internal service funds, and then our fiduciary, investment, private purpose, pension, and agency. So we want to become really familiar with those. Now that we understand and have some of that defined for us, we're going to take a look at the basic structure of the government-wide financial statements and fund financial statements. Now remember, 2 statements are required for government-wide financial statements. The first one being statement of net position, statement of activities. Reporting is separated into governmental activities, so all governmental funds and most internal service funds are reported in this area, and business type, all enterprise funds and remaining internal funds. So let's define this a little bit more. Government-wide financial statements do not include the transactions and balances of fiduciary funds. So we're only looking at governmental funds and proprietary funds. Okay. Fiduciary funds will have their own set of financial statements. So please bear that in mind. So here is an example of the statement of net position. What does that look like? Oh, it looks like a balance sheet, doesn't it? So you can see there, we have our governmental activities. So those are our government funds, the assets, liabilities, and what we call net position. And then we have the business type activities, which would be your proprietary funds, your enterprise funds, and some of your special interests. And then a total, because none of the fiduciary funds end up here. So I'll probably go back and forth here. So the economic resources measurement focus is used in government-wide financial statements. So all the assets and liabilities are reported. But GASB has identified several balances that do not qualify as either assets or liabilities. And they're shown as deferred outflows or deferred inflows. The final section where we're used to seeing equity instead is reported the net position category. It indicates the amount of capital assets being reported less liabilities. Legal or external restrictions on the use of any of the reported assets or resources are identified, and any unrestricted amount available for use by government officials is identified. So let's take a look back here. And you could see here, here's all the assets up in the top. Then we have something called unamortized cost of debt funding, refunding, which is called a deferred outflow. So that's an outflow later, but it's a resource. Then we have liabilities. Then we have deferred inflows of resources, net investment in capital assets, net investment in capital assets would be total assets minus total liabilities. Then we have net position restricted for capital projects, debt service, and then we have money unrestricted at all for both governmental activities and those business type. And we'll be taking a look at this even more, even in Chapter 12. Now, the statement of activities, government-wide, it's like our income statement. Now you can see we have columns, we have rows, we have self-government activities, business type activities. So the statement of activities provides details about our revenues and expenses, once again separated into governmental activities and business type activities. It's usually read horizontally first and then vertically. So it's saying our general fund. We had expenses of $3,200. We had program revenues of $1,400. So we had an overall loss, or expenses were greater. Public safety. Expenses were $9,700. Specific revenue towards it, $880. So the program revenue from public safety, maybe those were speeding tickets that funded it, $880. Public works, $2,600. Maybe, I don't know, it might be money coming in for some kind of a special assessment. $2,000 was the difference. You can see all of our expenses have been greater than the revenues coming in. Education, same thing there. So total governmental units, 23,900 in expenses. Revenues received, such as fines, fees, grants for this special activity, 3,180 in total. Now let's take a look at our business type of activities. Remember, we said those are things like collecting money for the water, the sewer, the airport. Well, here's your expenses. The water expense was $3,600, but the revenue generated $4,030. So we had a positive $430 from that type of activity. The sewer expenses were $49.20, but we collected fees of $56.10, $690. And then the airport, $2,300, but the fees collected there, $31.20. Now remember, the difference between the fees above and the fees below. Up here, they're going to be things like tickets and fines, and maybe a grant, maybe a small fee. Down here, the user is the one paying the fee, the user. Okay, so that's why it's more like a business. Because you can argue with me and say, well, aren't taxes? But taxes aren't saying, well, this tax is going to go and pay for your sewer. That's the difference. Fees collected up in the government are going for everybody's. Property taxes would be in our governmental activities, and those are general revenues coming in, investment earnings, and maybe transfers. It looks like the business type activities transferred $600 over to the governmental activities. This causes total government general revenues and transfers to be $21,420. Their expenses are $20,720. So the ultimate change in net position was $700 positive. It started at $980, so it ends at $1,680. And we would do the same thing for the business activities area. So that's how you read that. So it's showing you the expenses, the revenues by activity type and overall. So a single net revenue or net expense is determined by function. Okay. So those are your government-wide financial statements. Now we're going to take a look at fund financial statements. This is the stuff I learned back in the day. So some of this is, well, it's newer because I didn't learn it in college, but I've been out of college a long time too. But two statements are required for this: the balance sheet, the statement of revenue, expenditures, and other changes. Now this is a lot different than what we just looked at. We will be looking at three categories in the second fund financial statement: the revenues, expenditures, and what we call other financing sources and uses. So fund financial statements differ from government-wide financial statements for three reasons. Internal service funds are grouped with the fund they benefit. So remember, I said it's like a shared service area. You know, there's one central engineering department that may do work for different activities. Well, their cost will be in the specific activity they benefit or work with. Governmental activities use the economic resources measurement focus, and government funds use the current financial resources measurement focus. So different assets and liabilities are being reported by the two sets of statements. You'll see what I mean. The timing and recognition is different on the two financial statements. And the difference create the need actually for reconciliations between the two, which you're going to see in chapter 12. So now take a look at the fund financial statement. Take a look at the assets: cash, investments, receivables, supplies, and materials. There's no other assets here. Here's your general fund, library program, other governmental funds. So we keep it very simple here. Liabilities, there's two. They have something called unavailable property tax collections, and then fund balances: non-spendable, restricted, committed, assigned, unassigned. Wow, we've got to take a look at these things. We need them defined for us. The next one, statement of revenue and expenditures and other changes in fund balance. Take a look at that thing. Okay. So before we look at that, let's take a look back here. There we go. Before we look at that, let's go back to our first financial statement here, the balance sheet. Governmental accounting does not require a stockholder's equity section, as you saw. The term fund balance is used to report the amount of net current financial resources, assets minus liabilities, that are on the balance sheet at that time for each fund. These fund balances are reported within 5 categories. So here we go. What's each category? Non-spendable. As implied by the name, this amount of the fund's current financial resources cannot be spent. They're restricted normally because some assets, such as supplies and prepaid expenses, are simply not in a spendable form. So that means of the funds we have available to us, some of them we just can't spend because they're not cash, like prepaids and supplies and materials. Second, the financial resources are occasionally received that cannot be spent because there's externally imposed limitations. Maybe somebody donated a gift to us, and they said you can only use this income. I'm sorry, you can only use future income from the gift. You can't use the gift itself. Remember, permanent funds. So that is what would be in the non-spendable. Restricted. These are assets held by the government that must be spent in a manner that has been designated by an external party. So once we list assets and liabilities, the assets, cash, really, cash, investments, accounts receivable, and materials and supplies, subtract the liabilities. Now we've got to decide of that what's left, what category, how much of that goes in each of these categories. And that would be based on the money. For example, a grant from another government for a specified purpose, such as classroom teachers or playground equipment. That's a restriction. Committed fund balance. It's already been designated for a special purpose, not by an outside party, but by the highest level of decision-making authority within the government. So the state legislator might have voted to set aside $400 million of the current funds for a road construction. That amount would be in the committed area. Assigned.
Sorry about that. I had a problem with my microphone. Hopefully there isn't too much of a disconnect. So just to reiterate, we have fund balance non-spendable, fund balance restricted, and fund balance committed. Fund balance assigned, again, is usually not it's designated for a certain purpose, but it's not by the legislature, but by some type of decision-making body, maybe a finance committee. And then fund balance unassigned is normally found in the general fund and reflects any amount of financial resources that has not been designated externally or internally. So this amount is available to government officials for any purpose viewed as appropriate. So we need to make sure we define each of those items on our balance sheet. Now, just to go back very quickly. Again, here is our revenues, expenditures, and change in fund balance. So we don't say net income or net loss. No, the revenues will report all the money coming in, general fund, the library fund, other governmental funds, and then total, the expenditures paid, and if it's positive or negative between the expenditures and the revenues. And then if there's any other kind of financing sources and uses, and then an overall change in the fund balance. We'll reconcile that to the beginning balance to get the ending balance. So you can see these financial statements differ quite a bit. Remember, these are fund financial statements. The first ones we saw were government-wide financial statements. Okay, so how do we do fund accounting? We saw the end result. We know why we have to do it. The first thing that normally happens is that a budget is passed. So we're going to take a look at how we record items related to a budget and what we call subsequent encumbrances and expenditures. So a budget is very important in the public sector because it serves several purposes. First of all, it expresses public policy. For example, if more money is budgeted for childcare and less for the environment, both positive and negative consequences are likely to occur. Through the budget, citizens are made aware of the decisions made by our officials as to the allocation of these limited financial resources. It expresses financial intent for the upcoming fiscal year. So here's how the government plans to spend the money. It provides control by establishing spending limits. So it's not a free-for-all. Officials typically cannot spend more for a particular activity than has been budgeted. It offers a means of evaluating performance. So it allows us to compare between budget and actual. Indicates whether the government anticipates having sufficient revenues to pay for all of the expenditures that have been approved. So in the current economic climate, when many governments face declining revenues, the amount and handling of proposed deficits needs to be of interest to citizens. So that's the why. So now the how. So let's say the city officials, and it's the city officials who pass the budget, enact a motel excise tax to promote tourism and conventions. For 2017, the tax is expected to generate $490,000 in special revenues. That's the budget. The city council authorizes expenditures of $420 in total, and that's the breakdown. How do we record this? And we do. Normally in financial accounting, we don't record budgets, but we do here. We will debit in our special revenue fund, tourism and convention promotions, because this is being collected for a special purpose. Estimated revenues, tax levy will be debited. And then we will credit each of these appropriations. So the costs. This will cause an increase to our budgetary fund balance. Okay, so we debit the estimated revenues, credit the appropriations expected, and determine if there'll be an overall positive or negative to this program. Now, this could be used, the surplus can be used to help with future use of other government stuff, or in case there's not enough revenues collected to cover those appropriations. So we just leave it kind of hanging out there. But that's what we do in our various funds. Now, in a governmental unit, purchase commitments and contracts are also recorded. They're called encumbrances. So even though we may not have a liability yet, may not have received something, we have to record the commitment. We do this in government accounting. We don't do this in regular accounting. We often wait and record anything to do with this in regular accounting when we actually get the purchase. And you can see in the third bullet point. But in government accounting, we purchase commitments and contracts we sign are recorded, their effect right now, prior to any recognition of actual liability. And then when the item is received, a legal liability for payment replaces the commitment, and that encumbrance is removed from the accounting records and an expenditure account is created. So we're showing people we have this item. The encumbrance shows, hey, this has been ordered. You can't use this part of the money anymore. Sorry, let's take a look at some examples of what we're talking about here. If you go to page 536, page 536 of your book. We have here, assume a city's, and this is the second paragraph down, the city's police department orders $18,000 in equipment from an approved vendor. As an ongoing service activity, the police department is accounted for within the general fund. Okay, the day these are ordered, not when they receive them, the day they order in the general fund, we will debit encumbrances equipment $18,000. We will credit an encumbrances outstanding $18,000. This is just to show we've purchased something and that part of the budget is no longer available. Now, when they receive, take a look down the bottom. They'll reverse that journal entry. So now they'll debit encumbrance outstanding, credit encumbrance equipment, and record the actual expenditures. Expenditure equipment is debited, vouchers, which is like accounts payable, is credited. And these are all in the general fund because that's where the police department activity is accounted for. So it's to show you our budget and commitments or contracts we sign are recorded immediately in government accounting. Now, how do we report capital assets, supplies, and prepaid expenses, which is different than what we do in for-profit companies? Virtually no assets are recorded within the fund statements for governmental funds. So when we do a fund financial statement, you didn't see any long-term assets on that balance sheet. You saw cash, investments, accounts receivable, and materials and supplies, but nothing else. And we don't. Assets, capital assets. So expenditures for buying capital assets that we normally debit an asset for, they're recorded at acquisition and closed out at the end of the year as an expenditure, like an expense. So fund financial statements report the amount expended each period by the governmental funds, whether it's for a regular service expense or a capital asset. So prior to the development of government-wide financial statements, only a minimum amount of information was available to decision makers about capital assets. There was a listing included in the financial statements just for information purposes. Even then, the inclusion of infrastructure items was optional. So there was no information about how much the roads, the sidewalks, bridges, and the like. Okay. A bridge, for example, with proper care might last for more than 100 years, but they never said that. Now with the government-wide, they're required to report capital assets. And you'll see that in Chapter 12 more. About supplies and prepaids. That was another asset category you saw on your balance sheet. The acquisition of supplies and prepaid costs such as rent or insurance is not really complicated. An asset recorded at the time of acquisition and subsequently reclassified to expense as the asset's utility is consumed by time. Oh, that sounds familiar. So in our government-wide financial statements, we just do the accounting as we normally would. Okay. Now, how about for our fund? That's a little different. Reporting prepaid costs and supplies by the governmental funds within the fund financial statement is not so straightforward because they have a relatively short life, but they are not current financial resources that can be spent. They've already been spent. So we have a choice on how we do the accounting for them. And the first one is the purchase method. Traditionally, governmental funds have used the purchase method, which simply records such costs as expenditures at the point that a claim to current financial resources is created. So no asset is created. So there won't be a prepaid expense or supplies account on a fund financial statement. Yes, for the government-wide, no for fund. So, for example, City of Philadelphia discloses that supplies of governmental funds are recorded as expenditures when purchased rather than capitalized as inventory. So, any remaining supplies or prepaid items are disclosed okay, but they're not reported directly on the fund financial statement. Then there's the consumption method. So the purchases method is the modified accrual accounting, because the entire cost is recognized as an expenditure when the current financial resources are reduced. Some governments, though, choose to have their governmental funds report supplies and prepaid items using an accepted alternative known method as the consumption method. And it's just like accrual accounting. They're recorded, supplies or prepayments are recorded as assets as the utility is consumed. So as you use the asset up or times pass, it's reclassified to the expenditure account. So you have a choice there on how you would like to do the accounting for supplies and prepaid items. Modified accrual, or basically the accrual. Now, let's see what I want to have myself some notes here, things I want to point out to you. So when do we recognize revenues from various types of what we call non-exchange transactions? Because remember, the government isn't selling stuff. Not selling a service or not selling a product, so there's no exchange occurring. So revenues such as property taxes and income taxes and grants do not have the same type of exchange process as for profit entities. Like I just said, revenue for governmental organizations differs from revenue for businesses. So the revenue principle doesn't really apply to them. Governmental revenue is not true revenue for which an earnings process exists. The revenue is derived from non-exchange transactions, for which the government does not provide a direct and equal benefit for the amount received. Okay, so when you pay your, if somebody pays school taxes and they never had a children, what kind of service are they getting from the government for their school tax? That's what we're talking about there. So what procedures do we take to recognize? Non-exchange transactions are separated into 4 distinct classifications with its own rules as to when we recognize revenue. And the first is derived tax revenues. So these are tax assessments that occur when an underlying exchange does take place. Income taxes and sale taxes are common examples of derived tax revenues. A sale occurs, or income is earned and income tax is assessed. The tax is tied to an event, okay? Imposed non-exchange revenues are property taxes, fines and penalties. These are viewed as imposed. The government makes an assessment, but no underlying exchange occurred. With the property tax, for example, the government is taking ownership and not a specific event or transaction as the purpose of the tax. Government mandated non-exchange taxes. This includes monies such as grants conveyed from one government to another to help cover the cost of a required program. So they're mandated by law. For example, a state specifies that a city must create a homeless shelter and then provides a grant of $900,000. Voluntary non-exchange transactions. Money has been conveyed willingly to the state or local government by an individual, government, or organization for a particular purpose. Example, state might grant a city $1.3 million to help improve reading programs in local schools. Unless the state had mandated an enhancement in these programs, this grant is accounted for as a voluntary. So if it's mandated, now you're looking at government mandated non-exchange. So anytime the organization, or the government, I should say, is receiving revenues, it could be put into one, non-exchange transactions could be put into one of these 4 categories. Now, before we move on, there's examples of each category and how you record it on pages 542 through 544. So you want to make sure you take a look at them. I think they're pretty straightforward. When the company assesses a tax revenue, a derived tax revenue. So I should say here at the bottom of page 541, sales by businesses operating within a locality account for 100 million for the current year, and a sales tax of 4% is assessed. The following entry is required for the 4 million to be collected. So the government will debit receivable sales tax and credit revenue sales tax for that expected revenue. How about non-exchange revenue such as property taxes and fines? Well, when the government, take a look, illustrate October 1st. I like this example. Let's take a look. Middle of page 542. Assume on October 1st, year one, property tax assessment totaled $530,000 are mailed by the city of Albin to its citizens to finance the government during year two. So these tax revenues are for year two. Bills are being sent out in year one. And they can't make anybody pay until January 1 of year two, but some people pay early. So what happens? Well, at the end of year one, they did collect $28,500. They will debit cash, $28,500, and then they will credit a liability, unavailable property tax collections. Or I should say a deferred revenue. That's the way you can look at it. Deferred revenue. We got the money, we can't use it yet. It's for next year's budget. Now, on January 1 of year two, and if you keep reading through this, they figure some of the money they're not going to collect at all. It's going to become a bad debt. And some they're not going to collect until year three. So they're going to put the remaining amount of $500,000 in a property tax receivable that's still owed to them as of the beginning of year two. The part that they don't think they're going to collect at all, they credit allowance for uncollectible taxes, and it operates the same way as the allowance for doubtful accounts. And then they credit revenues, property taxes. Now, they will, at the beginning of year one, beginning of year two, now credit unavailable property tax collections, that deferred revenue account used for last year's collections, and credit revenue, because now those revenues can be used. So it's not when were they earned, but when do we use them? For what year? Also, oops. Nope, that's good. That's what we want to talk about there. Okay. So the top was for our financial statements. That's the government-wide financial statements journal entry. Take a look at the bottom. The bottom one says this. The part that's not going to be collected till year three, we can't call that revenue this year. It's not going to be available this year. So unavailable property tax collection of $30,000 will be recognized next year when we actually receive it. This is the difference between government-wide accounting, strict accrual, and modified fund accounting. So with the revenues, we're not going to show them all when we're doing our fund financial statements. The part that is not received in year two and won't be received until year three has to be shown as a unavailable property tax collection. The $30,000. All right. So just to make you a little familiar with those. Sometimes governments issue bonds. That's one way that they could raise money. Bond proceeds are not revenues to the government unit, but the proceeds serve as a major source of financing. These proceeds must be repaid so the government recognizes no revenue. Government-wide financial statements recognize cash received and debt incurred, so they'll debit cash, credit a liability. But fund statements recognize the cash received, but do not record the debt as a claim on the current financial resources. Quick look. Take a look on page 545. When the company issues, or I'm sorry, not the company, when the government issues bonds, they're going to, for fund financial statement purposes, they debit cash and they credit something called other financing sources bond proceeds. So they look at it as a source of funds, not as a liability. It is a liability, but for fund financial statements, it's not recognized as one when recording it. Before we go to the next area, special assessments, like you go to page 546. So when the government, when they're doing their company-wide financial statements, they would have debited cash, credited bonds payable. When they receive, I'm sorry, when they pay back the bonds, they're going to debit bond payable, debit interest expense, credit cash for purposes of government-wide financial statement. For purposes of fund financial statements, they're going to debit expenditure bond principal. Remember, when they got the money, they never credited a bonds payable account. They credited other financing sources. Well, now when they pay back part of the principal, they're going to debit expenditure bond principal because that was the amount they had to pay. They had to pay interest. So that's considered an expenditure on their debt service fund. Remember, that's where we have to show that we are paying money out. We're collecting money and paying it out and credit cash. So you see, it gets kind of squirrely, right? The last major area, I believe, okay, then we have interfund, are accounting for special assessment projects. So governments can provide improvements or services for particular properties, things like streets, curbs, sidewalks, sewers, and drains. And these are also usually financed by debt issuance and liens on the benefited property to ensure reimbursement. Oops, into my notes, just bear with me a second. So to help finance the work, the government usually issues debt and places lien on the property. Okay, so take a look on page 548. Here's a special assessment project. First, let's go to 547. What kind of journal entries would need to be made for your government-wide financial statement? Here, assume a sidewalk is to be added to a neighborhood at a cost of $600,000. The city will issue bonds to finance the construction. And then there's going to be repayment to be made using funds collected from the owners of the property benefited. Total interest is to be paid is $30,000. The assessment to the owners is set at $630,000 to cover all the costs. So it's saying, you know, up front they had to issue bonds, but they're going to collect that money over time off the property owners who benefited from this. Well, what happens with regards to this? For government-wide financial statement purposes, we would debit cash, credit bonds payable. We would debit infrastructure asset sidewalk and credit cash when you actually put the sidewalk in. Debit taxes receivable and credit revenue special assessment for the $630,000 owed by the taxpayers. Then, as the owners pay it, we will debit cash and credit that receivable. And then we would ultimately pay off the bond to the people who helped finance it to begin with. Pretty normal, what we're used to in financial accounting. Take a look at the fund financial statement journal entries. the day you get the cash, you debit cash and credit other financing sources, bond proceeds. You don't credit bonds payable. There's no liability account. No, this is considered a source of money in your special assessments project area, capital project funds. In the capital project funds, you're going to debit expenditure sidewalk and credit cash when you pay for the sidewalk. In the debt service fund, you'll account for the where you're going to get the money to pay back those bonds. So taxes receivable is debited, revenues are credited. Special assessment. Then the cash will be received from the special assessment to the property owners, credit taxes receivable. And then the ultimate payoff of the bond is an expenditure in the debt service fund, the principal and the interest, and then we would credit cash. But it's all handled through that debt service fund. Very different. We're not used to having different funds to account for different parts of a transaction, and that's what's happening here. That's where fund accounting is different. Sometimes there's transfers that occur within the funds maintained by the state or local government. So commonly used, particularly monetary transfers from the general fund. So they're normally reported as other financing sources and other financing uses instead of accounts or receivable from the debt fund, receivable from, no, we call them other financing sources, other financing uses. Intra-activity transactions between two governments or two enterprise funds are not reported in the government-wide financial statements because they create no net impact. Why? Because those two activities are usually reported together anyway in a government-wide financial statement. Separate funds, fund financial statements, separate funds are reported separately. But government-wide, we report them all together in a category. Interactivity transactions occur between government and enterprise funds. So those are the only ones you would see on a government-wide financial statement when they're between the two major classifications. And they give you some examples of those in the remaining chapters. So please take a look at those remaining journal entries. So lots of new and different stuff here. And it's the first chapter of 2 chapters, focusing on why we have special rules the Government Accounting Standards Board creates, why we need 2 sets of financial statements. We looked at the 2 sets of financials and some specific transactions to help create those in this chapter. So please take your time, absorb it all. Please post any questions that you may have to the discussion board.